We are looking in problem or in section 3.4 of the adjusting process. Let's look at what it reads. Students often ask when or how adjusting entries should be made. As a practical matter, adjusting entries should be made whenever financial statements are prepared because without adjusting entries, the update to revenues and expenses, the statements will be less reliable. And we're going to talk about these adjusting entries that need to be made and why they need to be made so that those statements that we're presenting not only are in conformity with GAAP, they're also accurate and reliable. We are adjusting for time. Write that down in parentheses. You adjust for time. Therefore, if your period of time statement is 3 months, you're adjusting accounts for 3 months. If your period of time income statement is for 6 months, you're adjusting accounts for 6 months. If your period of time statement is for a year, you must adjust the accounts reflected for that year. Here's the 7 adjusting entries. Here's what you need to remember, and here's what you need to know. The first adjusting entry is to adjust for revenues earned but not collected. And you've seen this before. Revenues earned but not collected. If they're earned, you know you provided the service or you sold the good. You earned the money. Whenever you earn the money, bells should go off, lights should flutter, your heart should be happy because you generated what? You generated a revenue. And remember on our cheat sheet, what do you always do with revenues? You always credit the revenue. What should we debit in the adjusting entry? We need to debit something to offset the credit. What are we going to debit? If you earned it, but you didn't collect it, that gives rise to what? An account receivable. So you're going to debit accounts receivable for revenues you earned, but you haven't collected. That is one of the 7 adjusting entries that you need to remember. If you earn the money, meaning you billed the customer, you performed the service, but you just didn't get the money, you earned it, you provided the service, you need to credit the revenue. Now the question is, did you get the money? If you didn't, it's an account receivable. If you got the money, you would debit cash. Plain and simple. We showed that in some of our previous journal entry transactions. In this matter, we are adjusting for revenues that we've earned for the period 6 months, 3 months, 2 months, 12 months, and we recorded the account receivable related to that revenue that we recorded. The second of 7 is going to be for what we call, and this is called, let me go back and say, this is called an accrued revenue, right? The second one is for expenses incurred but not paid. Keyword is you incurred it, but you didn't pay it. It's an expense. What do we always do with expenses? Go back to your cheat sheet. You're going to debit the expense, whatever the expense is. The key thing here is that you didn't pay it. You know you used it. That means it was incurred. You know you used it, and I've given you the example before about a cell phone bill. Usually when you get your cell phone bill, you're going to get your cell phone bill for the previous month's activity. So when the bill comes to you, you incurred an expense. The question is, did you pay for it immediately or did you pay for it later? In Mechanical Engineering, Inc., we saw that with the utility bill. They had a utility bill, but they didn't pay it. They debited the expense and they credited the payable. So you're going to debit the expense and you're going to credit the account payable for that expense. This is also known as an accrued expense. The third adjusting entry that we're going to get into is for prepaid expenses. Think about it. When I pay for something in advance, as you saw before, we prepaid rent or we prepaid insurance. At the end of 3 months or 6 months or 12 months, whatever that period of time is, I've used what I prepaid for. The adjusting entry then requires us to adjust the prepayment to its proper balance, thus reducing that prepayment for what's been used. Here's the adjusting entry for prepaid expenses. You're going to debit the expense, whatever that expense that was prepaid is, and you're going to credit the prepaid expense. So let's say it was insurance that you bought on January 1st. You paid $1,200 for the year. That insurance now, you're recording a financial statement, an income statement for 6 months. You paid $1,200 on January 1st for the entire year. 6 months have gone by and it's now June 30th. That is the period of time that's being reflected on your income statement. You don't have $1,200 of prepaid expense left. You have only half. You have $600 left. Therefore, if you didn't adjust it, your prepaid expense item on your balance sheet as a current asset will still be $1,200. You know the correct amount is $600. This is how we adjust it to get it to that $600. We would debit in that situation prepaid rent for $600 or insurance, and then we would credit the prepaid insurance expense for the $600 that was used. All right, you recognize the used portion of the prepayment. That's number 3. Number 4 is for unearned revenue. Unearned revenue, I said to you multiple times, and I'll say it again so that you don't forget, unearned revenue is a liability. Unearned revenue is a liability. Unearned revenue is a liability. Unearned revenue is a deferred revenue or a liability that will ultimately become a revenue on the income statement when we do what? When we earn it. Unearned revenue gives rise to the fact that we got money in advance from a customer that we did not perform the services for. We didn't earn it. And until we earn it, it does not become a revenue. When we do earn it, it will become a revenue. So the adjustment will be for the liability, the current liability on the balance sheet of unearned revenue that has now been earned. So in that, you will debit the unearned revenue and you will credit revenues. Doing this helps you then to record the portion of the unearned amount that you have now earned by providing the service. That is 4 of the 7. And in just a moment, we'll get you the remaining 3 of the 7 adjusting entries.